Is JPMorgan Chase Bank behind the October 10th crash and the reason that Bitcoin is dumping? Are they trying to destroy Bitcoin and MicroStrategy at the same time? This is your Altcoin Buzz News. Hey, what's up everyone? My name is Cody, and if you're new here, make sure to like, subscribe, and turn on notifications so you will drop latest content. Follow us on Twitter, altcoinbuzz.io, and as always, is not financial advice, and wish the best of luck in your crypto ventures. Also, make sure to join us for our X Spaces, Tuesday to Friday at 9 a.m. EST, link down below. All right, good morning, guys. So over the weekend, we pretty much just hovered around this $86,000 range. We went to $80,000 last week, and I do still think we could come down and sweep these lows around $75,000 in this big area of support down here. So I think that's a possibility. It is possible that this was the little bounce we had over the weekend from $80,000 to $86,000. I would like to see us go a little bit higher because we've just been selling off massively for weeks now. I would like to see a little bit higher of a pump, but we'll have to see if we get that. And we're going to talk about why Bitcoin is potentially dumping coming up in the news here. But starting off today, we have a big week for crypto. Monday, we have the Fed injects liquidity. Tuesday, we have the FOMC meeting and PPI data release. Wednesday, we have initial jobless claims in U.S.-China deal signing. And on Friday, the president signs a Bitcoin reserve bill. Mega bullish week for crypto is coming. At the same time, we have Merlin the trader saying Binance is getting massive stablecoin inflows. Historically, this happens right before major accumulation bursts. Smart money is positioning. Retail is panicking. Don't sleep on this signal. And Ash Crypto says the odds of a December rate cut has jumped to 75.5%. More rate cuts are coming. So it was a little bit lower. We were getting pretty bearish signals here that the rate cut was not, a foregone conclusion for December. The percentage was a bit lower, but now we're kind of back up to 75%. Before it was around 95%. So we're getting back up there. At the same time, we have breaking crypto billionaire Justin Steiner just bought 1,800 Bitcoin worth over $150 million. His total Bitcoin holdings exceed 500 million. He definitely knows something. Then we have the biggest story of the day and really the weekend right now. We have, is JPMorgan trying to bankrupt MicroStrategy? They're shorting MSTR and dumping Bitcoin to liquidate Saylor and profit billions. Watch out for another round of manipulation today. We also have Jack Mallers, a big Bitcoin maxi, who says, last month, JPMorgan Chase threw me out of the bank. It was bizarre. My dad has been a private client there for 30 plus years. Every time I asked them why, they kept saying the same thing. We aren't allowed to tell you. So we have JPMorgan versus Strategy and Bitcoiners is officially the hottest drama on crypto Twitter. The stakes, serious allegations, billions on the line, and community mobilization to boycott JPMorgan. It all started with the sudden Bitcoin and MSTR dumps. Nobody knew what was happening. Then on Friday, Rand Neuner dropped the bomb. These moves may have been tied to potential MicroStrategy listing from the MSCI and NASDAQ, and that's when CT woke up. So we finally know why the market crashed on the 10th of October and why it just can't bounce. We never really understood why the big crypto crash started on October 10th and why we couldn't even get a single meaningful bounce. Today, the answer is simple. Let me break it down. DATs, or digital asset treasuries like MSTR, BMNR, and others have been one of two big buyers that power the cycle. The DAT game is simple. You need to be the biggest so that you get into the big indices, and when you do, passive index trackers are forced to buy large amounts of your stock. As they do, you get bigger and add to more indices, and so the cycle perpetuates. On exactly October 10th, MSCI, the world's second biggest index company, published below. They're questioning whether companies that hold crypto assets as their core business should be considered as companies or as funds. If they're funds, they're not included in passive indexing. Why? Because this creates a circular loop. The fund buys assets, gets bigger, and then is included in more indices and buys more assets. The expected ruling will be announced on the 15th of January 2026. If this does pass, then companies like MSCR will be automatically removed from all indices. If this happens, it would mean that all pension funds, normal funds, and other passive index holders would dump their MSTR automatically. It would also mean that going forward, they would never be included, and as such, one of the big reasons why they actually exist would disappear. Since DATs have been powering this cycle and have been the most buying pressure, the smart money saw this immediately after the 10th of October announcement and positioned accordingly. The 10th of October wasn't a coincidence after all. It was smart money seeing the big risk of crypto in the current market structure. The market will probably continue to dump until around the end of December. If the announcement is negative, we'll get a huge dump in preparation for the removal of the indices. But on the other hand, if it's positive, the bull market is back. And so you can see here, at the same time we had this, big tariff news, which was Trump announcing tariffs on China on October 10th. That was just a smokescreen for what was actually happening on October 10th, where they are preparing to delist a lot of these DAT companies. And then moving on, we have Emperor Digital, who called JPMorgan's sudden bearish MSCI report a direct attack and designed to create selling pressure to push Strategy out of the NASDAQ 100 and the MSCI indexes. And then adding more fuel, he exposed that on July 7th, JPMorgan unnecessarily hiked MSCR margin requirements across the entire firm. In his view, this single move triggered chaos, spiked volatility, nuked the price, and liquidated traders across the board. So I'll play this video for you real quick.
So some of the comments online, people are talking about some of the previous videos and the timing on JPMorgan. okay, and when they actually increase the margin requirement on MSTR. So let's look at that, right? So I have an email here from JPMorgan on July 7th, okay? That is when they did a firm-wide increase in the margin requirement for MSTR. Now, let's look at that, right? So we have a chart here, right? And I overlaid the vol on that chart. Let's look at July 7th, this line here, okay? Now, on July 7th, the 90-day vol was going down between June and July. The 60-day vol is going down between June and July and continues to trend down. Stock price is stable, goes up for a bit, but now look, as they put this firm-wide margin requirement increase on MSTR, it goes up, but then it pretty much precipitously goes down, right? People had to liquidate that security. Now, there is no risk model at that time that would have told JP Morgan they should be increasing the margin requirement. This is a coordinated attack.
And then a few hours later, Hodl Maryland released an article connecting even more dots. JP Morgan's history, the timing of the attack, and the possible role of a Trump administration. It blew up to nearly 2 million views and sparked a debate across the entire crypto Twitter. So the article is called Trump's Gambit, the Quiet War Between the White House and JP Morgan. Over the past few months, a pattern has emerged across politics, markets, and media. Scattered headlines sounded connected, market anomalies look less accidental, and institutional actors are behaving with unusual aggression. Something deeper is happening beneath the surface. This is not a normal monetary cycle. This is not traditional partisanship. This is not market volatility. What we're witnessing is a direct confrontation between two competing monetary regimes. The old order centered around JP Morgan, Wall Street, and the Federal Reserve, and the new order centered around Treasury, stablecoins, and a Bitcoin-anchored digital architecture. This conflict is not theoretical anymore, it's live, it's accelerating, and for the first time in decades, it's spilling into the public view. So first off, is JP Morgan a step out of the shadows? Most people think of JP Morgan as a bank, which is a mistake. JP Morgan is the operational arm of the global financial establishment, the entity that sits closest to the Federal Reserve's core mechanisms, influences dollar settlement worldwide, and acts as the primary enforcer of the legacy monetary architecture. So when Trump posted about Epstein's network and explicitly named JP Morgan instead of isolating individuals, it wasn't rhetorically flourish. He pulled the system's most embedded institutions into the narrative. Meanwhile, JP Morgan is a primary facilitator in aggressive short pressure on strategy, precisely at the moment when Bitcoin's macro narrative threatens legacy monetary interests. Clients trying to transfer the MSTR shares out of JP Morgan report delivery delays, hinting at custody stress, the kind that only appears when internal plumbing is under strain. JP Morgan sits in the strategic heart of the Fed ecosystem, both structurally and politically. Undermining its position is equivalent to undermining the old monetary regime itself. Then there's the administration's silent pivot, return monetary power to the Treasury. While media fixates on the cultural war distractions, the real strategic agenda is monetary. The administration is quietly working to pull the center of monetary issuance back towards the US Treasury, using Treasury integrated stablecoins, programmable settlement rails, and Bitcoin reserves as long-duration collateral. This shift doesn't tweak the existing system, it replaces the system's core power center. And right now, the Fed and commercial banks, led by JP Morgan, intermediate virtually all dollar creation and distribution. If the Treasury plus stablecoins becomes the issuance and settlement backbone, the banking system loses authority, profits, and control. JP Morgan understands this, and they understand exactly what stablecoins represent. They understand what happens if the Treasury becomes the issuer of programmable dollars. So they fight, not with press releases, but with market tactics. Derivatives pressure, liquidity choke points, narrative suppression, custodial delays, and political influence. This isn't a policy dispute, it's an existential struggle. And then there's Bitcoin, the unintended battleground. Bitcoin is not the target, it's the terrain. The administration wants quiet strategic accumulation before making any explicit moves towards a Treasury-anchored digital settlement system. A premature announcement would ignite a gamma squeeze, sending Bitcoin to escape velocity and make accumulation prohibitively expensive. The problem, the old system is using gold-style suppression mechanisms to crush the Bitcoin signal. Paper derivatives flooding, massive synthetic shorting, perception warfare, liquidity raids at key technical levels, and custodial bottlenecks at major prime brokers. JP Morgan has spent decades mastering these techniques on gold, now they're applying them to Bitcoin. Not because Bitcoin threatens banking profits directly, but because Bitcoin strengthens the Treasury's future monetary architecture and weakens the Fed. The administration faces a brutal strategic choice: let JP Morgan continue to suppress Bitcoin, preserving the ability to accumulate at lower prices, or make a strategic announcement, triggering a Bitcoin breakout and losing stealth positioning before political alignment is secured. This is why the administration remains publicly quiet on Bitcoin, not because they don't understand it, but because they understand it too well. And both sides are fighting on fragile foundation. This entire struggle is occurring atop a monetary regime built over 6 decades of financialization, structural leverage, artificially low rates, asset-first growth, reserve concentration, and institutional cartelization. Historical correlations are breaking everywhere because the system is no longer coherent. TradFi pundits who treat this like a normal cycle fail to grasp that the cycle itself is dissolving. The regime is fracturing, the plumbing is unstable, and the incentives are diverging. And both factions, JPMorgan's legacy order and the Treasury's emerging order, are fighting on the same brittle infrastructure. One miscalculation risks cascading instability. This is why the moves appear so strange, so disjointed, and so frantic. And then there's Microstrategy, the conversion bridge under direct assault. Now we introduce a critical layer that most commentators miss. MicroStrategy is not just another corporate Bitcoin holder, it's become a conversion mechanism, the bridge between legacy institutional capital and the emergent Bitcoin treasury monetary architecture. MicroStrategy's structure is leverage Bitcoin strategy. Its preferred equity product effectively convert fiat, credit, and treasury assets into long duration Bitcoin exposure, and in doing so, MicroStrategy has become the de facto on-ramp for institutions and retail who cannot or will not hold spot Bitcoin directly, but will need relief from artificially suppressed yields from YCC. Which means if the administration envisions a future where treasury-backed digital dollars and Bitcoin reserves coexist, MicroStrategy is a crucial corporate conduit towards that transition. And JPMorgan knows that, so when JPMorgan facilitates heavy shorting, introduces delivery days, pressures MicroStrategy liquidity, and fuels negative market narratives, it's not simply attacking Michael Saylor, it's attacking the conversion bridge that makes the admin's long-term accumulation strategy viable. There's even a plausible scenario, one still very speculative, but increasingly logical, where the US government eventually steps in and takes a strategic investment in MicroStrategy. As suggested recently by Josh Mandel, that could come in the form of receiving MicroStrategy ownership in return for the injunction of US Treasuries, which would explicitly support the MicroStrategy preferred vehicles and support higher credit ratings. Such a move would carry risk politically and financially, but it would also send a signal the world cannot ignore. The United States is defending a critical node in its emerging monetary architecture, and that possibility alone explains the intensity of JPMorgan's attacks. And then there's a critical window: control of Federal Reserve Board. Here's where the timeline turns urgent. As Caitlin Long recently suggested, Trump needs functional control of the Fed's governance before Powell leaves the stage. Right now, the balance is against him. He trails by roughly 3 or 4 votes on the board. Several choke points now collide at once. Lisa Cook's Supreme Court challenge, which could drag on for months and delay key shifts, the February 2025 Fed governor vote, which could cement hostile governance for years, and the coming midterms, where an underperforming GOP would cripple the administration's ability to realign monetary authority. This is why economic momentum is essential now, not 6 months from now. And then the broader strategic picture. When you stand back, the pattern becomes unmistakable. JPMorgan is waging a defensive war to preserve the Fed banking system, where it's the primary global node. The administration is executing a stealth transition to restore monetary primacy to Treasury through stablecoins and Bitcoin reserves. Bitcoin is a proxy battleground where price suppression protects the old system and stealth accumulation powers the new one. MicroStrategy is a conversion bridge, the institutional on-ramp that threatens JPMorgan's chokehold on capital inflows. Fed governance is the choke point, and political timing is the constraint, and everything is happening on an unstable foundation where the wrong move triggers unpredictable systemic consequences. This isn't a financial story, it isn't a political story, it's a civilization-scale monetary transition, and for the first time in 60 years, the conflict is no longer hidden. So it goes on for a little bit longer, but those are the main points that I wanted to share, and a really good article I recommend checking out as well. At the same time, there's also a new video of Eric Trump starting to circulate, claiming JPMorgan had undermined his family and their business. We've heard this many times before, but specifically JPMorgan. Meanwhile, Michael Saylor stepped in. He defended strategy against MSCI's potential index exclusion, reminding everyone that MicroStrategy is a real software company, not a fund, with $500 million in revenue and issuing $7.7 billion in innovative Bitcoin-backed securities. Then came another bomb. Adam Livingston called for a full boycott of JPMorgan, citing under-reported Epstein-linked suspicion transactions prior to 2019. And then Grant Cardone jumped in as well. Earlier, he had said that he's preparing to sue JPMorgan over $20 million for card-related issues. And then Max Kaiser entered the chat. He hinted at potentially massive news. The US government may be preparing to invest in MicroStrategy and Coinbase. And unconfirmed but explosive, JPMorgan may be holding a massive short position on MicroStrategy. So in conclusion, the reason this cycle has felt so different, maybe so suppressed, is because of how big this is in the global monetary scale, how much, the government, the new government, the Trump administration wants to change the way the monetary system works to the Treasury, away from the Fed, and how JPMorgan wants to keep the old narrative. So this is a lot of very good points. I definitely would recommend checking all this out as well. It goes on even farther and farther, but this video would be like an hour long if I just read through all of it. A lot of really good points, a lot of good reasons why Bitcoin is still being suppressed. And so what can we do about that? Well, we have to really see what happens going into the end of the year and towards January 15th when this decision will be made. If that decision does go through and, MicroStrategy and all these other DATs are removed from these indexes, then we're going to see a lot more selling pressure. A lot more dads are going to have to sell their Ethereum, their Bitcoin as well, and what other coins that dads are holding. I think some are holding Solana, whatever. So if these dads have to then go and sell all of their coins, there's going to be a lot more selling pressure. And I do think in terms of Bitcoin, it will create an opportunity to buy, Bitcoin for cheaper prices wherever that might be. And wherever that is, I think we're going to have, great buying opportunities for Bitcoin. For other altcoins, it's hard to say, when they'll come back. But for Bitcoin, for sure, if these DATs are excluded and we have a huge cascade of selling, I do think at that point, we're going to see, a generational buying opportunity for Bitcoin. Now, this does kind of lead into the next quarter. So it is kind of like we're going into December and January for when this news does come out. But it does kind of put a little bit of an explanation behind why Bitcoin is, selling off so much and why October 10th really was that date that kind of put the nail in the coffin when, everything kind of just blew up. And it seems we have a little bit more of a explanation behind it now. So that's the video for today, guys. I hope you enjoyed, and I'll see you tomorrow.